Imagine waking up one morning to find that the market you've trusted for years has suddenly collapsed, billions wiped out overnight, retirement accounts slashed in half, and years of savings gone in a flash. Sounds extreme, right? But history tells us this isn't just possible. It's happened before, and many experts believe we could be living through the largest bubble in stock market history right now. The real question is, are we prepared for what happens when it bursts? For most people, the stock market feels like a steady engine of wealth creation. You invest, you wait, and over the long run, you see growth. It's what we've been told for decades. And historically, that has proven true. But every so often, markets enter a phase of irrational enthusiasm when prices rise not because of underlying fundamentals, but because of hype, speculation, and the fear of missing out. This is what we call a bubble. And just like every bubble in history, it eventually pops. The scary part about bubbles is that they don't always look obvious when you're living through them. In fact, when everyone around you is making money, it feels like you're the crazy one for being cautious. Think about the dot-com bubble in the late 1990s. Back then, any company with "com" in its name could go public and immediately skyrocket, even if it had no profits, no business model, and sometimes not even a real product. People believed the internet would change everything, which it did. But valuations got so far ahead of reality that when the bubble burst, trillions of dollars vanished. Or take the 2008 housing market crash. Home prices kept climbing higher, fueled by cheap loans, risky lending, and the belief that real estate always goes up. People bought multiple houses they couldn't afford. Banks packaged bad mortgages into securities, and Wall Street sold them as safe investments. It all looked unstoppable until it wasn't. When the bubble popped, it triggered one of the worst financial crises in history. So here's the question we need to ask today. Are we repeating the same mistakes, only on an even larger scale? If you look at valuations, debt levels, and the sheer speed of recent price increases in certain sectors, it's hard not to see parallels. Stock prices have climbed to levels that seem detached from earnings. Companies are valued at astronomical multiples, and speculation in areas like tech and AI stocks has reached a fever pitch. At the same time, retail investors, everyday people, are pouring money into the market, often chasing trends without understanding the risks. That combination of euphoria and blind optimism is exactly what has preceded every major crash in the past. But here's what makes the situation even more dangerous. This isn't just about individual stocks or one sector. Low interest rates, government stimulus, and easy credit have fueled a surge across the entire financial system. Investment, the safety nets that used to keep markets in check, have been stretched thin, and that creates a fragile environment where even a small shock, like a policy change, a geopolitical crisis, or a sudden loss of confidence, could trigger a cascade. Now, I don't say any of this to scare you for the sake of fear. In fact, the goal here is the opposite: to prepare, to understand, and to make smarter financial decisions. Because if history teaches us anything, it's that bubbles aren't just about danger. They're also about opportunity. Those who recognize the signs early, who position themselves wisely, and who avoid the emotional roller coaster of the crowd, investment, often come out stronger on the other side. In this speech, I'm going to break down what makes this moment in history so unique, why many believe we are in the largest bubble the stock market has ever seen, and most importantly, what you can do to protect yourself and your financial future. By the end, you'll not only understand the risks, but also the strategies that can help you survive and even thrive when the bubble eventually bursts. So let's dive in. When we talk about financial bubbles, one of the most important things to understand is how they form and what the warning signs look like. A bubble doesn't appear out of nowhere. It builds slowly, fueled by a mix of optimism, a speculation, and a belief that prices will keep climbing forever. The problem is that most people only realize it was a bubble after it has already popped. That's why identifying the warning signs ahead of time is so critical. If we know what to look for, we can avoid the mistakes that leave so many investors devastated when the music stops. One of the first and clearest signs of a bubble is when valuations rise far beyond what fundamentals can justify. In simple terms, a company's stock price should have some relationship to its earnings, cash flow, or future potential. When you see prices climbing at a rate that earnings cannot keep up with, that's a red flag. For example, if a company is losing money every quarter, but its stock price keeps doubling because investors believe it will eventually dominate an industry, that's speculation driving the price, not fundamentals. We saw this in the late 1990s with internet companies that had no profits, but traded at billions of dollars in valuation. The logic back then was that profits don't matter right now, growth does. That's almost word for word the same rationale you hear today around certain hot sectors, especially in technology. Another warning sign is when credit and leverage expand dramatically. In almost every bubble, investment, easy access to borrowed money plays a central role. Cheap credit encourages investors to take bigger risks because it feels like there's little downside. During the housing bubble of the early 2000s, People with little to no income could qualify for massive mortgages. Banks themselves were highly leveraged, borrowing heavily to fund even more lending. When things go well, leverage magnifies returns, but when they go badly, it magnifies losses. If you see a system where borrowing is skyrocketing and debt levels are rising faster than incomes or profits, you should immediately be cautious. Today, both consumer debt and corporate debt are near record highs, which mirrors conditions that have historically preceded crashes. Excessive speculation by retail investors is another common signal. When you start hearing stories of people with no financial background making quick fortunes in the market, it often means euphoria is taking hold. This isn't to say everyday people shouldn't invest. In fact, they absolutely should. But there's a big difference between long-term investing and short-term gambling. In bubbles, it's the gambling mindset that takes over. People pile into whatever is going up without understanding the risks, assuming they'll sell before things turn around. History shows that very few ever managed to do so. During the dot-com bubble, investment, taxi drivers, and hairdressers were day trading tech stocks between clients. During the housing bubble, everyone seemed to own multiple homes. Today, social media platforms are filled with people sharing get rich quick, stock tips, and that level of widespread speculative behavior is worth paying attention to. A subtler but equally dangerous warning sign is when rational concerns are brushed aside by the majority. Every bubble has its skeptics, but they are often dismissed as pessimists who just don't get it. In the 1920s, when the stock market was booming before the Great Depression, anyone who warned of danger was mocked. In the 2000s, those who pointed out the housing market's flaws were ignored or ridiculed. When you notice that mainstream narratives frame skeptics as crazy while glorifying those taking the biggest risks, that's usually a signal that optimism has reached dangerous levels. Right now, investment. You can see that in how analysts who warn about high valuations are often drowned out by louder voices insisting that this time is different. Another critical factor to watch is government and central bank policy. Low interest rates and easy money tend to fuel bubbles because they make borrowing cheap and push investors toward riskier assets in search of higher returns. When safe investments like bonds yield next to nothing, people are more likely to put money into speculative stocks. Over the last decade, central banks have kept interest rates historically low, and governments have added trillions in stimulus. While these policies were intended to stabilize the economy, they also poured gasoline on the stock market. The result is an environment where asset prices have inflated across the board, from equities to real estate to collectibles. When these conditions shift, say, if interest rates rise or liquidity tightens, it often exposes just how fragile the bubble really was. Finally, watch for cultural mania around investing. Bubbles don't just live in financial charts, they show up in everyday life. When investing becomes a form of entertainment, when it dominates conversations at family gatherings, or when people start quitting their jobs because trading feels like a better career, you can be sure speculation is rampant. This happened in the 1920s, the 1990s, and the mid-2000s. Today, with the rise of trading apps and viral social media accounts, the stock market has become part of pop culture in a way we haven't seen before. That cultural enthusiasm is not inherently bad, but paired with high valuations and heavy speculation, it's a warning sign that should not be ignored. Taken together, these signals, overvalued assets, skyrocketing debt, widespread speculation, dismissal of skeptics, easy money policies, and cultural mania, form the anatomy of a bubble. None of them by themselves guarantee a crash, but when they appear together, history shows the outcome is usually the same. Prices rise to unsustainable heights, confidence builds to the point of arrogance, and then something shifts. Maybe it's a change in interest rates, maybe it's a financial shock, maybe it's just that people collectively realize valuations don't make sense. Whatever the trigger, the pattern ends the same way with a sharp and painful correction. The challenge for investors is that it's incredibly hard to pinpoint the exact moment when a bubble will burst. If you get out too early, you miss potential gains. If you stay in too long, you risk devastating losses. That's why the key is not to predict the precise timing, but to recognize the conditions and adjust accordingly. Knowing the warning signs gives you the perspective to protect yourself when others are blinded by euphoria. And in a world where many believe we are in the largest bubble the stock market has ever seen, that knowledge might be the most valuable investment you can make. When we look back at financial history, one of the clearest truths is that bubbles are not new. They've appeared again and again, often in slightly different forms, but always with the same underlying psychology. Each time people believe the present is unique, that this time is different. And that somehow the rules of finance and human behavior have changed. Yet every bubble, from tulips in the 1600s to tech stocks in the 2000s, has followed the same path: rapid growth, mass speculation, investment, overconfidence, and eventually collapse. By studying these past crashes, we can learn not only how they unfolded, but also what lessons apply to today's market environment. One of the earliest and most famous bubbles was the Dutch tulip mania of the 1630s. At its peak, tulips were selling for the price of a house. It meant people weren't buying them for beauty or utility, they were buying because they believed someone else would pay more tomorrow. When confidence cracked, prices plummeted, and fortunes were destroyed almost overnight. The lesson here is simple but powerful. When the value of an asset becomes detached from its actual usefulness or ability to generate income, you are looking at pure speculation. The same psychology has reappeared in every bubble since. Fast forward to the 1920s and the stock market boom before the Great Depression. At that time, people believed prosperity would continue indefinitely. Borrowing money to buy stocks became incredibly common, with investors putting down a fraction of the cost and using leverage to magnify their gains. It worked beautifully until it didn't. When prices began to decline in 1929, leveraged positions unraveled quickly, forcing mass sell-offs that spiraled into a historic collapse. The crash not only wiped out investors, but also triggered a decade-long economic depression. The lesson here is the danger of leverage. Borrowed money amplifies gains, but it amplifies losses even more brutally. And in a bubble, when prices reverse, leverage becomes a ticking time bomb. Then came the dot-com bubble of the late 1990s and early 2000s, which offers striking similarities to the current moment. Investment. Back then, the internet was transforming the world, and investors rushed to pour money into any company with a "come" in its name. Many of these businesses had no revenue, no profits, and sometimes no real business model. Investment. Yet their valuations soared into the billions based purely on the idea that they might one day dominate their industries. When reality set in, the Nasdaq lost nearly 80% of its value from peak to trough, and countless investors were wiped out. Investment. The lesson from the dot-com crash is that even revolutionary technologies can create bubbles when hype outpaces fundamentals. The internet did indeed change the world, but that didn't stop speculative valuations from collapsing first. This is a cautionary tale for today's environment, especially in areas like artificial intelligence and speculative tech. The housing market crash of 2008 is another vital case study. For years leading up to the crisis, the idea that real estate always goes up, became a widely accepted truth. Banks made loans to people who couldn't afford them. Mortgage-backed securities spread risk across the global financial system, and home prices kept climbing. It seemed unstoppable. But when homeowners started defaulting and lenders realized the securities were built on weak foundations, the entire system came crashing down. Millions of families lost their homes, financial institutions failed, and governments were forced into massive bailouts. The lesson from 2008 is that when debt speculation and blind optimism collide, the consequences spread far beyond individual investors. They can threaten the entire economy. What ties all of these bubbles together is the psychology of crowds. People tend to follow trends, trust the majority, and assume that if everyone else is making money, they should too. This herd mentality is incredibly powerful. It overrides logic, dismisses caution, and convinces people that risks don't apply to them. But when the bubble bursts, it's that very herd that rushes for the exits all at once, making the collapse even more severe. The lesson here is that just because the crowd believes something doesn't make it safe or sustainable. In fact, when everyone is rushing into an investment, it may be the most dangerous time to join. Another key lesson is the importance of timing. In every crash, there were people who saw the signs early. Economists warned about housing in the mid-2000s, skeptics highlighted absurd valuations in the dot-com era, and even in 1929, some investors pointed out excessive leverage. The problem is that timing the exact peak is nearly impossible. Markets can stay irrational longer than you can stay patient. That's why the takeaway isn't about trying to perfectly predict the top, but rather recognizing when risk outweighs potential reward. It's about knowing when to reduce exposure, diversify, or shift strategies, even if the market continues to rise a little longer. Finally, history shows us that while bubbles are painful, they also reset opportunities. After every crash, the strongest companies survive and thrive. And long-term investors who remain disciplined often come out ahead. Those who avoided over-leverage, who focused on fundamentals, and who kept cash reserves were able to buy valuable assets at discounted prices. This is perhaps the most encouraging lesson. Bubbles eventually pop, but they also create opportunities for those who are prepared. In short, the lessons from past crashes are clear. Speculation detached from reality is dangerous. Leverage can be destructive. Herd mentality blinds even smart people. Timing the exact moment of collapse is impossible, but recognizing the warning signs and acting prudently is essential. And most importantly, while bubbles end painfully, they also create new beginnings for disciplined investors. By keeping these lessons in mind, we can navigate the uncertainty of today's market with clearer eyes and stronger strategies. When comparing today's stock market environment to past bubbles, the similarities are difficult to ignore. In fact, many economists argue that what we're seeing right now may be the most extreme version of a financial bubble in history. To understand why, we need to look at valuations, monetary policy, investor behavior, and the broader economic backdrop. Each of these areas reveals patterns that echo previous bubbles, only amplified to an even greater degree. The first place to start is valuations. Historically, stock prices tend to fluctuate around a certain range relative to company earnings. The price-to-earnings ratio, or PD ratio, has long been a standard measure of whether stocks are cheap or expensive compared to their profits. For most of modern history, the average PDE for the S&P 500 has hovered around 15 to 16. Today, that number is much higher, in some cases double or more, depending on the sector. This means that investors are paying far more for each dollar of earnings than they have in the past. Now, high valuations by themselves don't automatically guarantee a crash. After all, strong earnings growth can eventually justify higher prices. But historically, markets that reach these extremes struggle to deliver sustainable returns. Beyond earnings, we also see speculation driving valuations in certain industries far beyond reasonable expectations. Technology, and particularly artificial intelligence, is the standout example. Companies that barely turn a profit are valued at hundreds of billions of dollars based purely on future potential. This is eerily similar to the dot-com bubble, when the belief in the transformative power of the internet justified sky-high valuations regardless of current profitability. The difference today is that AI, electric vehicles, and other hot sectors have access to a much larger global pool of capital, fueled by trillions of dollars of liquidity that didn't exist in earlier eras. The result is a scale of speculation that could exceed anything we've witnessed before. Monetary policy has also played a significant role in inflating today's markets. For over a decade, interest rates remained near zero, and central banks pumped massive amounts of liquidity into the financial system through quantitative easing. This easy money environment pushed investors away from safe assets like bonds, which offered virtually no return, and into riskier assets like stocks, real estate, and even cryptocurrencies. And the effect has been a broad inflation of asset prices across the board. This is different from past bubbles, which were often concentrated in specific sectors. Today, the bubble may be systemic, touching nearly every corner of the financial markets. Another factor is the role of government stimulus. Following the global pandemic, governments around the world injected trillions of dollars directly into households and businesses. This influx of cash didn't just stabilize the economy, it also created a wave of new investors. Millions of people who had never traded before suddenly had money, access to trading apps, and plenty of free time. The surge in retail participation, combined with social media platforms that spread market hype at lightning speed, has fueled a new kind of speculative frenzy. This isn't entirely unlike what happened during the roaring 1920s, when the stock market became a national pastime. But the speed and scale are far greater today thanks to technology. Corporate debt is another area of concern. Companies have taken advantage of low interest rates to borrow heavily, often not to invest in growth, but to buy back their own stock. This financial engineering has helped push share prices higher, but it also leaves companies more vulnerable if interest rates rise or if earnings decline. In previous bubbles, excessive borrowing has been a recurring theme, and the sheer volume of debt in today's corporate sector suggests that the fallout from a downturn could be particularly severe. At the same time, consumer debt is also near record highs. Credit card balances, auto loans, investment, and student loans have all surged. This leaves households more financially fragile, which matters because consumer spending is a major driver of corporate earnings. If debt burdens become unsustainable, it could create a feedback loop where falling consumer demand weakens corporate profits, which in turn undermines already stretched valuations. This combination of high leverage and elevated prices has been the Achilles heel of past bubbles. Investment, it's a major risk in the current market. Investor psychology provides perhaps the clearest comparison. In almost every bubble, optimism turns into euphoria, and skepticism gets drowned out by the belief that the future will justify today's prices. Right now, the narrative around technology, innovation, and central bank support has created exactly that sense of invincibility. Just as people once believed real estate always goes up or the internet will change everything, many now believe that disruptive technologies will drive endless growth and that central banks will always step in to prevent disaster. The problem is that such beliefs have never held up indefinitely. When reality intrudes, it tends to do so brutally. It's also worth noting that today's market is globalized in a way that past bubbles were not. Capital flows instantly across borders, and shocks in one part of the world can reverberate everywhere within minutes. This interconnectedness increases the scale of both the upside and the downside. A crash in one region's stock market or real estate sector can quickly trigger chain reactions across the globe, amplifying the impact of any downturn. When you put all these pieces together, stretched valuations, speculative enthusiasm, massive liquidity injections, record debt levels, and overconfidence in the system. It paints a picture that looks uncomfortably similar to every major bubble in history. The difference is that today's version may be broader, deeper, investment, and more interconnected than any before it. If history is a guide, this doesn't mean the market will collapse tomorrow, but it does mean that the conditions for a severe correction are in place. The comparison to past bubbles isn't just academic, it's a warning. And if this truly is the largest bubble in stock market history, the lessons we take from it will be even more critical than those of the past. When it comes to protecting yourself during what many believe could be the largest stock market bubble in history, investment, the key isn't to panic or to completely avoid investing. The real focus should be on building a strategy that allows you to grow wealth while also preparing for the possibility of a major downturn. Crashes are unpredictable in their timing, but they are inevitable in the long run. Those who manage to preserve their capital and keep a disciplined approach often emerge from the chaos much stronger than those who gamble everything on the idea that prices will only rise. The first step to protecting yourself is diversification. Too many investors fall into the trap of concentrating their wealth into a single asset class, industry, or even one company in bubbles. This concentration looks brilliant on the way up, but devastating on the way down. During the dot-com bubble, many people had all their money in internet stocks. When the market collapsed, they were wiped out. Similarly, during the housing crisis, investment, countless families had the bulk of their wealth tied to real estate. A smarter approach is to spread risk across different area stocks, bonds, real estate, and even alternative assets. The idea is not that every asset will always perform well, but that some will hold steady when others are crashing. That balance can prevent catastrophic losses. The second step is understanding the role of cash. In times of euphoria, cash is often dismissed as dead money because it doesn't generate high returns. But in reality, cash is both a hedge and an opportunity. When markets are at extreme valuations, having cash on the sidelines gives you flexibility. It means you're not forced to sell investments at a loss to cover expenses, and it allows you to buy valuable assets at discounted prices when the bubble bursts. Historically, those who kept cash reserves during crashes were able to scoop up high-quality stocks at bargain levels, setting themselves up for enormous long-term gains. Rather than thinking of cash as a wasted opportunity, think of it as insurance and dry powder for future growth. Another essential element is risk management. That means being honest about how much volatility you can stomach without making emotional mistakes. It's easy to say you'll hold through a downturn when the market is rising, but when your portfolio suddenly loses 40%, panic becomes very real. Setting stop losses, rebalancing regularly, investment, and avoiding excessive leverage are practical ways to control risk. If you're invested in individual stocks, consider scaling out of positions that have become extremely overvalued. If your portfolio is too heavily weighted toward one sector, shift some of that exposure into safer, more stable investments. These adjustments don't mean abandoning growth. They mean creating a portfolio that can survive both bull and bear markets. Investment. Paying attention to valuation is another form of protection. While it's tempting to chase the hottest stocks or sectors, history shows that buying into companies at extreme valuations almost always leads to disappointment. Instead, look for businesses with strong fundamentals, consistent earnings, manageable debt, and a track record of weathering economic cycles. These kinds of companies may not deliver the same short-term thrill as speculative stocks, but they're far more likely to preserve wealth when bubbles burst. Value investing, dividend-paying stocks, and defensive sectors like utilities or healthcare often hold up better during downturns and provide steady income when growth slows. Investment. It's also critical to prepare mentally and emotionally. The psychology of investing is one of the biggest challenges during a bubble. When everyone around you seems to be getting rich overnight, it's hard to resist the temptation to chase returns. On the other side, when panic hits and prices are collapsing, it's equally hard to stay disciplined and avoid selling at the worst possible time. Protecting yourself means creating a clear plan in advance, deciding how much you're willing to risk, how much cash you'll hold, and what circumstances would cause you to adjust your strategy. By setting rules before emotions take over, you give yourself a far better chance of sticking to rational decisions when markets become irrational. Another strategy to consider is dollar cost averaging. Instead of putting all your money into the market at once, spread your investments over time. This reduces the risk of buying at the very top of a bubble and smooths out your average purchase price. If markets rise, you still benefit, and if they fall, you get to buy at cheaper levels. This disciplined approach takes timing out of the equation and prevents big mistakes caused by trying to predict short-term moves. Don't overlook the importance of multiple income streams outside the stock market. Relying solely on market returns leaves you vulnerable to volatility. Building side businesses, investing in rental properties, or developing skills that increase your earning power can create financial security that doesn't depend entirely on asset prices. During downturns, those who have multiple sources of income are far less likely to be forced into bad decisions. like selling investments at the bottom. Finally, remember that bubbles always end, and they always create new opportunities. The people who thrive after a crash are not the ones who tried to predict the exact peak or avoided investing altogether. They are the ones who stayed disciplined, managed risk, and had the patience to invest when everyone else was too scared. Protecting yourself isn't just about avoiding losses, it's about positioning yourself to take advantage of the recovery that inevitably follows. In the end, building wealth safely in a bubble environment is about balance. It's about resisting the urge to chase hype, preparing for volatility, and thinking long-term when everyone else is thinking short-term. By diversifying, holding cash, managing risk, focusing on fundamentals, and keeping emotions in check, you can navigate even the largest bubble in history without losing your financial future. And when the dust settles, you'll be ready not just to survive, but to grow stronger in the aftermath.